Hey guys, my name is Matthew Spazziti here with New Millennium Wealth, and welcome back to the channel. Hope you guys are having a great day today. Today I wanted to kind of come to you guys and just more or less talk with you a little bit about what it is to backtest a trading strategy. This is a topic that's always talked about and everything. A lot of people get a little confused, and it's really not that complicated of a topic. It's fairly simple. You just need to ultimately create a strategy, write it down in like a Word document, and then basically backtest it and record your backtesting in an Excel document. And that's more or less it. You need to find a trading platform that you can go to get historical trading data that you can backtest your strategy over. And yeah, that's pretty much it. It's a pretty simple process overall. So I kind of wanted to go through that. I'm in the process of backtesting a trading plan right now. A new strategy I created not that long ago. I've already backtested it over one currency pair, and I want to start backtesting it over a second one. And since this is really my journey to becoming a consistently profitable trader, I wanted to offer you guys the opportunity to come with me and actually start showing you what the process looks like and the challenges and the successes that you guys are going to encounter. So today I wanted to go ahead and transition into the computer, and you guys are going to be able to see my screen. I'm going to kind of talk to you guys today a little bit about how to actually backtest, how to formulate a strategy, and kind of just go over the basics. And then I'm going to actually show you guys what it's actually like to backtest. Now, granted, this is going to take this can take a very long time, so I'm going to have to cut it down a little bit so that it's actually viewable. Otherwise, it would be hours and hours of video because it takes a long time just to backtest one currency pair. You can lock yourself into a room and spend weeks on it. It can literally take weeks, or you can do it in a couple days. It kind of just depends on your drive and how fast you're finding the patterns and things of that nature. But ultimately, I wanted to kind of show you that process and kind of get out there and finally show you the strategy that I'm trading, and things of that nature. All right, guys, well, let's go ahead and jump into the charts. All right, guys, so let's go ahead and jump into the topic. So like I said in the intro, I wanted to go over and show you guys my trading plan. I wanted to show you guys my backtesting trading journal, and basically just discuss the importance of all of this, of why we should be looking at making a trading plan and also recording each and every trade that we take. Whether you are backtesting or whether you're trading with real money and you're trading live, or whether you're forward testing on where you're trading with fake money on a demo account just to see if your strategy would work live. Either way, you should always be recording your trades. But before we even do that, we have to actually come up with a strategy. So as you can see here, you're currently looking at my trading plan. It's my 2786 trading plan. The 2 in the 2786 is in reference to a double top or double bottom. If you don't know what that is, that's okay. We will cover that here in a little bit. And the 786 is in reference to a Fibonacci ratio. Again, if you don't know what that is, that's all right. We will talk about it when we start jumping into the charts today, which we will eventually get around to doing. So basically, Fibonacci ratios are just ratios that are used to, they're measurements that are used to measure the different price movements, price action movements, and things of that nature. So that's it, in the short term, that's basically what it is. So having said that, let's go ahead and jump into this. So this is a trading strategy, a trading plan that I kind of made and based it largely off of somebody else's trading plan. It was one of my mentors. He gave it as a template to all the people that purchased his course. And I took it. I kept some of the things that he wrote here, like failure is a choice. I'm pretty sure I kept that. I don't believe in failure. You only fail when you quit. Or I believe that financial markets are 100% psychology driven. Some of this stuff is actually stuff that he actually had in here, and I just basically left it in there because I was like, yeah, okay, I would agree with that. Sure, I totally agree with that. So I'm gonna adopt it as my trading philosophy as well. But I also added in quite a few things. Like this. I'm a moderate intraday swing trader in the Forex market. I will only trade the 2786 trading strategy on the 60-minute and 240-minute charts, so the 4-hour chart, and daily charts only.
I will use the weekly charts for my top-down analysis when I'm taking trades on the daily charts. I will use the daily for my top-down analysis when I'm taking trades on the, you can kind of read the rest, so on and so forth. Basically, if I'm going to take a trade on the daily chart here, I'm going to look at the weekly chart to see what direction the market is moving. You see, when you're looking at different, I'm trying to figure out how to explain this. When you're looking at different time frames, okay, and you're looking at, say, the daily chart might show you that we are in a bullish trend pattern, like we're in a bullish trend. However, if you look at the weekly chart and you zoom out all the way and you zoom out farther, what you might actually see is we're actually bearish. We're actually in a bearish trend. We're moving down. But the bullish trend on the daily is simply like a pop. It's a retracement. It's it is a fractal move in the market. The markets move in fractals. Basically, you can have moves inside of other moves. You can have trends inside of other trends. So you can have a small bullish trend inside of a much larger bearish trend. And that can happen. So in order to try to solve and get around that problem, what we would effectively do is we would look on the larger time frames. We would zoom out and we would see what is the overall trend. The overall trend is bearish, but right now we're in a retracement period. The market is retracing the opposite direction, but it's given no indication that it's going to maintain that and reverse trends on a longer basis. So it's in this shorter term retracement bullish trend, and it more than likely will continue the bearish trend later on. And that's the general idea there. So, I've added stuff like this and whatnot. I've also added the currency pairs that I would like to trade. As you can see, I added a lot of currency pairs. I bolded the ones that I actually will backtest on because I realized that backtesting, when I really got into backtesting, I didn't realize it was going to take as long as it was. And yeah, I quickly came to realize that backtesting takes a very long time. So I decided to effectively narrow down my currency pairs, and I narrowed them down to these bolded ones: the Aussie USD, Aussie CAD, CAD Swiss, Euro Yen, Euro Dollar, Pound Yen, New Zealand Dollar, and USD CAD. Let's see, and the dollar. Oh, the dollar CAD and dollar Yen right here. And these are the 9 different currency pairs. These are probably some of the major pairs is what they're called, and these are very, very good pairs that you can basically go ahead and trade. They have a lot of liquidity to them, and some of them have a lot of volatility. You need volatility to trade in, and when I mean a lot, I'm more to say they have enough volatility to trade. Some of these, like the pound, I believe it's the pound yen, one of my mentors has called the beast because the volatility can be very high on the pound yen, and you can end up losing your shirt very quickly when you're trading it because of the high volatility on it. So it's just important to keep that stuff in mind. But those are the pairs that I'm currently focused on. I've already backtested the Aussie CAD, and it so far has a positive expectancy on the hourly chart. Now I'm going to show you how I backtest, and I'm going to show you all this stuff on the Aussie dollar. This is going to be the next currency pair that I'm going under, and then I will continue on to all these other currency pairs. Whether or not I will record all of those others, I don't know if I will, because I think you'll ultimately get the idea behind the Aussie dollar, and it will slow me down a lot more if I'm recording all of this. But I do want to show you how I backtest and everything, and I'm going to show you my backtesting journey for the Aussie dollar. And I will be recording, I'll probably be posting multiple videos on this, and it'll just be a series of how do you create a trading plan, how do you create a trading journal, and how do you backtest. And that's basically what this is going to be, the first video of that series. So, as you can see under, this is my rules of engagement, my ROE. And basically, it kind of tells you what you're going to be okay with doing, what you're not going to be okay. Like, I will be okay with taking and holding trades overnight or over the weekend. Guys, these may seem minor things, but they're very important that you need to identify, because given the moment, you're going to take a trade, and you're going to hold it over the weekend. And if you lose money, you might say, "Oh crap, why did I do that? You know what? I'm never going to hold it over the weekend." But then you're gonna not hold it over the weekend, only to realize that if you did, you would have actually made money. And then you're like, "Ah, man, now I gotta hold it." You see, now I need to hold it over the weekend. That's why it's important to list it out in your trade. It's hard set. Now you just need to follow that plan. Okay, it's hard set. It's hard, and you've written it down. And yes, technically speaking, you can always change it, but be very careful when you're doing that. Don't just constantly change your trading plan, okay? You don't want to fall into what's called a shiny object syndrome, where this is generally a term used for when you're coming up when you're learning trading strategies, and you're looking at different patterns and how to trade those patterns and whatnot, and oh, well, I saw this pattern, I really liked it, so I tested it, didn't do well, I'm going to jump to this other pattern. Oh, well, I didn't perform very well, I'm going to jump to this one. And guys, I'll be honest, I have done that. It's very easy to fall into. Now, thankfully, I never did it with real money. So, thank goodness I never did. There's a lot of people who start trading right away the minute they learn about trading, and they end up losing their shirt. And thankfully, I haven't done that yet. And hopefully I won't ever do that. But thankfully, I haven't experienced shiny object syndrome with real money, but I have experienced it with backtesting. I started backtesting a strategy that I was told was incredibly high performing. And in my own backtesting, in my own experience, I didn't really see the high performance that I was told that it supposedly had. And then come to realize it only had that high performance on only a select few currency pairs and on a select few time frames. And yeah, that kind of sucked when I realized that. But, in my backtesting, I only experienced, so this is how it went. I only experienced the good performance on the Aussie CAD. And it was a decent performance. But on the Aussie dollar, it was terrible. It just did nothing but lose. And then I started to change the plan. How could I improve the performance? And then I started to tweak the rules a little bit for the Aussie dollar, seeing if I could tweak the performance and get it to perform well. And then I figured, well, if I get it to perform well, I'll apply that to the Aussie CAD again. And, I've already found the trades. I've already recorded them. It won't take me as much time to go through this again. So I'll just go ahead and do that. And I'll be honest, that was not a good idea. I did change the trading strategy to see if I could have it perform better on the Aussie dollar, and it didn't. It didn't work. The fact of the matter is the pattern just did not work at least during the time frame that I tested it on the hourly chart, and during the years and months that I tested it over, it did not work. And, you kind of have to come to a realization. Do you really want to trade a strategy that didn't work for a year or two? And I said no. And after I constantly was changing the rules of entry, I was constantly changing the trading strategy itself, and nothing worked. I mean, it was consistently profitable on Aussie CAD. It was not on Aussie dollar. And I had to come to terms with that. But then I decided, you know what? I'm going to backtest something different. And that's kind of what led me to this strategy. So you see, I've already strategy jumped. And it's already cost me a lot of time in my trading journey. So if there's any one big advice I can give you, any one, golden egg that I can give to you, I want you to, it would be don't get caught in shiny object syndrome. Don't get caught in jumping from one strategy to another. Stick with a strategy, backtest it out over all the currency pairs and the time frames that you've identified that you want to backtest it over, and then call it good. Whether it's profitable or not, just stick with it. Don't do what I did. Don't jump from one strategy to the next. Actually, there was another strategy. I jumped into another strategy, and I started testing it over. Let me see. I was testing it over stocks, I believe, and the volatility on the stocks. I was testing a strategy over Apple, and I don't really remember what strategy it was. I'm kind of thinking it was the 2786 strategy, or maybe it was the 2618. The 2786 strategy is a strategy that I kind of developed based off of the 2618 strategy, which I'll kind of go over the differences of the two strategies later. They're very similar. It's just when you enter and whatnot is the biggest and most defining feature of the strategy. So anyways, moving on from there, this is the general idea. This is how you would construct and organize your trading plan. As you can see, I've only got 4 pages, 1239 words. It's not that bad. Basically, this is what you would do when looking to take a trade. Look for a double top / double bottom. In order to identify this, first the market must be trending with an extension, retracement, and then another extension. That is what I need. That is the requirements I need in order to classify the market as trending. Okay, I need an extension in one direction, a retracement in the opposite, and then I need an extension in the previous direction that it started in the first place. Okay, an extension, retracement, extension is a trend. That's what I define as a trend. Okay, so I need to see that. Second, a clear gap must occur between the two price retests in order to be considered as a double top, double bottom. Okay, again, a double top, double bottom looks very much, a double top looks like an M, a double bottom looks like a W, and basically, again, we will go into that when we jump into the charts, but you just kind of stick with me here. But yeah, so I'm not going to go through each and every trading rule, but you can kind of get this. This is really laid out and organized in a code kind of fashion. Like if you're into coding, that's what this is laid out in. Like, if you see this, then do this. If I see this, then do this. So it's an if-then thought process. So if price action creates a trend, then look for a double top. If you see a double top or a double bottom, if one has been identified, then look for a break of structure of the V that the double top or double bottom have made. So you see, it's an if-then thought process. And, this basically just tells you when to get in the market, what patterns you need to see in the market in order to take a trade. When all your criteria is met, where do you enter and where do you exit? And you should have all this stuff determined before you take any trade, mind you. Anytime you're trading, you should always have your exits and your entries planned out ahead of time. You should know, without even really thinking about it, where you're going to enter and where you're going to exit, like where your stop loss is going to be, where your target's going to be, and then on top of that, where do you enter? And what happens if it moves past your entry? Well, if it provides a more favorable trade and a lower entry point and less risk, then hey, totally go for that. But at minimum, I need I would enter at a 786 Fibonacci retracement level. Okay, and again, when we get into the charts, I'll show you that. So that's basically this. As you can see, I have modified this a little bit here because that needs to be fixed. Okay, so basically, as you can, this is the general idea. You see, I've also had notes, gaps, and identifying trends. So, things here that I have, I felt it was necessary to elaborate a bit on to be a bit more descriptive of how to identify a trend or what to do if the market gaps, this and whatnot. Now, granted, in the Forex market, in my personal experience, I have not seen, the Forex market, it does not gap all the time. It's not as common, or at least I don't believe it's as common as stocks. Okay, stocks gap a lot, particularly when there's a massive amount of investors and a lot of traders of very high volume. Stocks tend to gap all the time, and a lot of that's also because the close of the day and news could occur after trading hours, and therefore it spikes prices too quickly for the charts to really pick up on. So it just kind of leaves a gap there on the next trading day. You don't really have that in the Forex market, not as often. It's not to say that it doesn't happen. Guys, gapping does happen in the Forex market. It just doesn't happen as often, in my experience. It doesn't happen as often as it does in the stock market. Okay, and I can't really speak to the commodity market, the futures market. I'm not entirely sure if it happens a lot there or not. So, okay, and what happens if you get conflicting signals? If you're getting these signals and you're not sure what to do, sit on your hands and don't trade until you get a clear signal. Just don't trade. Guys, that is a very difficult thing to do. I can speak from experience. In my back testing, I've had conflicting signals, and I wanted to take both. And you could, if you want to. There is really no right or wrong answer here with developing these trading strategies. There's really no right or wrong answer. If you want to take the trade, and if you want to take both and see how they both work out and see if you benefit, then fine, do that. I prefer to just sit on my hands and do nothing until I get a much clearer trading signal. Make sure not to trade at a time frame. So don't take patterns that are too large or too small for your time frame. So I was also struggling with that, particularly with one of my first strategies I used to trade. I used to trade these massive patterns on the hourly chart. And it turned out that a lot of times that just was not a good idea, because in reality, you're taking because it was such a big pattern, the risk was significantly higher, and the pattern really could have been traded on the daily chart. It was so big. And yet I was on the hourly. So that would be trading outside the time period, or taking a tiny trade that's so small that in reality, it's really not an hourly trade. It's really more of a 15-minute or 30-minute trading, strategy. So, how you can fix that is you can have minimums that say, I will only take trades that has a minimum of making me $20 or whatever, or 20 pips. And, you can do stuff like that to try, or I will only, I will not take trades that are going to risk 3%. I will only risk a maximum of 3% of my account, or what have you. I mean, whatever, usually you will have to define a minimum and a maximum with regards to how much you're going to trade, with regards to the size of the trade and things like that. And that'll help you maintain trading in your time frame. This is an interesting rule right here. I will only risk a maximum of 3% of my account. As the account's equity grows, the maximum risk percentage will need to be lowered. If the account's equity shrinks, the maximum risk will need to be lowered as well. So I'm not going to be starting with a very large trading account. My trading account is currently around $3,000. It's not that much money, okay? And to be completely fair with you, 3% of that is not a lot. It really isn't. So when you're talking about, trading, you need to determine what's your maximum risk going to be and kind of go from there, So, I mean, it's something that's really important to define. So some people would say 3% is too much. Some people say you should only risk a maximum of 1 to 2%, but then your account would hardly ever grow. 3% of $3,000 is like $90. That will be okay for most of the trades that I'm going to be taking. So 3% is actually a very, very decent amount of money. Now, again, you also have to consider, what's your maximum drawdown and a lot of other things that you will discover when you get into trading. So that I feel like this sums up gives you a general idea of what a trading plan is, and allows you to ultimately, just kind of get an idea and ultimately see firsthand what a trading plan could actually look like. And this is mine. I wake up at 7 a.m. in the morning. Honestly, I really should say more like 7:30, but I pull up TradingView, I look at my currency pairs that I've back tested and whatnot, which is currently only one. And so yeah, you identify your daily routine. Oh, this right here is the formula to smooth ratio money management technique. When you do actually get into a successful strategy and you find that edge in the market where you are consistently profitable, what really makes or breaks you is this. It is money management. How do you manage your money? When do you increase your position size? When do you decrease? Okay? And that's basically because as you start to grow, as your account starts to grow and become larger, you want to start increasing your position size. And you're still controlling your risk, but you want to increase the position size in order to, continually make more and more money with your account. But the question is, how do you do that? Some people use a fixed ratio money management. I will only risk a maximum of like this 3%, right? But sticking to a fixed ratio money management technique is very difficult and will cause your trading to, I guess you would say, take longer. I mean, it would make it very difficult for your it would make it very difficult for you to increase your account size. Let's just say that. It would make it would take longer, versus with the smooth ratio money management technique, you will be able to grow your account at a much more reasonable rate. All right, so I think we covered pretty much everything in the trading plan. You want to have a trading philosophy or trading psychology. You want to have rules for engagement. You want to have your actual trading strategy, and you want to list out the rules with regards to your if-then thought process. You want to identify what you will be trading, the time frames that you will be trading, how much you're going to risk, and just, general stuff. I'll be okay holding trades overnight or things of that nature. Then you might actually want to get a bit more in depth and start defining things like, what is a gap, or how do I handle gaps, or what is a trend, how do I handle trends, what happens if I get conflicting signals, what happens if I'm trading out of my time frame, things of that nature, and what kind of money management technique am I going to use. Guys, these are all things that you want to include in your trading plan. And again, this will take a little while. You'll need to sit down, you'll need to brainstorm. Don't get upset if it takes a long time, guys. This took me a while to come up with. It really helped to actually have a template from one of my mentors. It certainly helped cut down the time, and it also helped me a lot to just simply see what a trading strategy, what a trading plan actually looked like, and actually be able to see the structure and how you worded it and things of that nature. So now that you're seeing this, I hope that this will really help you, give you an idea what it's going to be like, and this will make your trading strategy and your trading plan creation much easier.
All right, guys, thanks for watching. If you like this content, please like the video, subscribe to the channel, and don't forget to check out the website at newmillenniumwealth.com. Guys, please share the content and help me spread this message of financial freedom. If you guys will do that for me, I'll see you guys in the next video. Remember, know the risks, plan accordingly, and have a great day.